Welcome back to the channel, everyone. Today I want to talk about the senators that are predicting a stock market crash, and actually they know the stock market is about to crash because they're already acting on it and selling shares. And I also want to talk about short exempt AMC shares as well. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So this post on Reddit says they know something is coming. Senator Tuberville predicts that Adobe is going to fall from $600 to $400 a share by January, so in only a month and a half. We can see here that on the 10th of December, Senator Tuberville took out a few put options. He took out a put option on Adobe to $400 by the 21st of January, a put option on Microsoft by the 18th of March, and a put option on Apple by the 17th of June. Now, if we look at Adobe, it's currently trading at around $615 per share. It hasn't traded as low as $400 a share since June of 2020, but Senator Tuberville predicts it's going to fall all of that way by January. We have Microsoft currently trading at around $328 per share, which Senator Tuberville is predicting is going to fall to $210 a share, where it hasn't been since November of 2020, by March. So again, over only the next few months. He's predicting over a 33% drop in the Microsoft share price over the next few months, which is absolutely incredible. So obviously he knows something is going on. But he's not the only one. I'll leave the link to this website down in the description below, but effectively this is the Senate Stock Watcher that watches all of the buys and sells from current US senators. We also saw Senator John Hickenlooper sell off pretty much his entire portfolio back in November. He sold off between $250,000 and $500,000 in PayPal, between $500,000 and $1 million in Nvidia, between $250,000 and $500,000 in Microsoft. He sold Facebook, he sold Apple, he sold Amazon, he sold Google, and he also sold some of his TTD. So that's around $6 million worth of stocks that John Hickenlooper sold back in November. Obviously, we also saw Senator Tuberville sell around $400,000 worth of his stocks, as well as obviously purchasing those put options. Now, using this website, you can also scroll back and look at some of the other sell dates back in December, back in November, and before then in October as well if you want. But clearly the senators know something is going to happen if they're selling off pretty much their entire portfolios and buying put options with fairly short expiration dates. Right now, Moomoo are currently giving away 5 free shares valued up to $3,500 each, and a free iPhone 13 Pro and many other goodies every single day this month until Christmas. When you sign up to Moomoo using the link in the description below and open your account, you get that first free share valued up to $3,500. When you make your first deposit for any amount, even if it's only a single dollar, you get that second free share, also valued up to $3,500. If you deposit $100, then you're entered into a chance to win a free iPhone 13 Pro and many other goodies every single day this month. And if you can deposit $2,000, then you get those final 3 remaining free shares, all valued up to $3,500 each. So that's potentially up to $17,500 in free shares and an iPhone 13 Pro to gift to a loved one this Christmas. Now, we also have the short interest data from yesterday, the 14th of December, and we saw a new all-time high or new record of short exempt volume in AMC, with 1.2 million shares marked as short exempt. Now, I also wanted to quickly explain what a short exempt transaction actually is, with the use of apparently exempt.com. So they've said, what is short exempt? Short exempt refers to a short sale order exempted from the uptick rule regulation as governed by the Securities and Exchange Commission's regulation SHO. The current regulation allows for a comparatively small number of restrictions, and within those restrictions are an even smaller fraction of exemptions to that rule. These exemptions are intended to allow brokers to best serve their customers in panicked markets. Short exempt orders are allowed to initiate the short selling of securities even during times they may be otherwise restricted, such as under SSR. So obviously during SSR, shorts are typically only allowed to short a stock on an uptick, as in when the stock is moving back upwards, then a short can short more shares, but when a stock is moving downwards, they're not allowed to short. But obviously by marking those short transactions as short exempt, they can continue shorting when they shouldn't be. And this is how the shorts are continuing to try and push the AMC price down, by shorting even when they shouldn't be. But obviously it didn't work yesterday, as retail's buying pressure even overrode the shares that they were shorting. Now I also wanted to talk about why the AMC and GameStop MOAS is absolutely still on, and why some people, like Dr. Quantrillions, aren't even worried in the slightest about the price action and the drop over the last few days. He said, number one, everything is declining. The Dow Jones, the S&P, the Nasdaq, it's all in the red. Huge crypto drops as well, and even Apple was down the other day. And he said that broad market declines have been one of the missing major catalysts, or one of the key ingredients, for months. And he says that's what we need right now. Large drops that threaten short hedge fund liquidity and their margin, and will make them fail to meet those collateral requirements. Because obviously, yes, these short hedge funds are shorting AMC, but they're long on many other stocks in the market. When those stocks go down and the stock price falls, so does their unrealized profits, and so does their ability to meet those collateral requirements and those margin calls. And he says, number three, the lower the price of AMC, the closer we are to the mother of all short squeezes. He says, you're probably tired of hearing the saying, the bigger the dip, the bigger the rip, but why? He says when it comes time to cover, every hedge fund wants to be the first to get out at the lowest price. And he says when the share price drops, it's low-hanging fruit and therefore easier for that first hedge fund to get out. But obviously other hedge funds are going to be tempted to try and close at even lower prices, and therefore the last one to cover is effectively the rotten egg and is effectively the hedge fund that will be liquidated. And he says number four, at the moment, over 90% of all trades are going through different dark pools or alternative trading systems, which is obviously the biggest figure we've ever seen. He says number five, short volume has been over 50% all week, and obviously we're now seeing that short exempt volume skyrocketing as well. He says over half of all trades are shorting action for at least the last 5 trading days. This only means one thing, desperation. He also says, number 7, that we're now lining up with historical short squeezes as well. In the mechanics of a short squeeze, massive decreases in price occur mere days before the rip. In the infamous 2008 Volkswagen squeeze, the stock price suffered a 51% drop in the 6 trading days before the rip. On top of that, in Overstock, the Overstock stock also took quite a drop before their short squeeze. He also says the technicals look amazing right now, and I know that because AMC and GameStop are so heavily manipulated, we can't really use technical analysis, but there has been some textbook application of Wyckoff patterns in there as well. We've also got buy volume still exceeding sell volume by a huge ratio, and option markets are also now on our side. Options move the market more than anything else, and market makers are being forced to shoot themselves in the foot right now through share hedging. Delta sensitivity is through the roof. Because obviously so many calls are currently out of the money, none of these calls are being hedged for, and delta sensitivity is through the roof. So when AMC does start moving back upwards, those call options are going to be very, very cheap for us to purchase, but very, very expensive for those hedge funds to hedge for. And he also says Evergrande bonds, well, again, enough said. But I also want to touch on something new, someone newer than Evergrande and potentially far, far worse than Evergrande. Sophia says a collapse of Shimao will be far, far worse than Evergrande. If high quality firms across hospitality, services and development focused on high quality markets such as Shanghai can't even survive the crisis, then global confidence will be permanently lost. Over the last 3 months, Shimao's bond has dropped from obviously being 100 cents on the dollar or over 100 cents on the dollar to around 60 cents on the dollar. Bloomberg is now reporting a crash in Shimao bonds stokes contagion fear and bailout speculation. Now, the reason why a Shimao collapse could be far worse than Evergrande is because Evergrande focused on many surrounding cities in China, some of those less popular cities, and some cities that aren't currently really built or have very, very, very little population. But Shimao focuses on some of the most major cities in China as well. Therefore, Evergrande was naturally seen as something more higher risk because they were focusing on less popular cities. But Shimao has been seen as someone a lot more secure because they focus on only the bigger cities. Bloomberg is saying its balance sheet is less than a third the size of China's Evergrande, and it doesn't even crack the top 10 list of Chinese property companies by sales. But for many investors, Shimao Group Holdings has suddenly become the single biggest worry in a Chinese real estate sector with no shortage of things to worry about. Long considered one of the industry's healthier players, Shimao, until recently, appeared largely immune to the credit market turmoil that led to defaults this month by junk-rated rivals including Evergrande and kohrs. It says that view has changed dramatically over the last week as unconfirmed speculation of payment difficulties at Shimao sent the company's bonds tumbling from nearly 90 cents on the dollar to only 59 cents as of Wednesday. Now, this is a company that still has bonds that are rated investment grade by Fitch, but in a few days could soon end up worthless and in default, just like the Evergrande bonds as well. Now, this is going to mean that those hedge funds also can't use Shimao bonds to meet their collateral requirements. And on top of this, Standard & Poor's are saying that Chinese banks could see their bad loan ratio of property loans more than double by the end of 2021 from the middle of this year. They said the non-performing loan or NPL ratio of property loans at Chinese banks may rise to 5.5% by the year end from 2.5% in mid-2021 and 2% at the end of 2020. Now, I don't know about you, but this to me sounds very much like this scene from The Big Short.
Sir.
Zero. There is a 0% chance that your subprime losses will stop at 5%. Zero. Excuse me. I have to take this.
He must be from Bank of America.
And therefore, it seems like the Chinese property market crash is not only going to affect Chinese property developers, but also the Chinese financial system as well. Guys, be sure to let me know down in the comments below what you think about the senators selling all of their stock and predicting the coming market crash. And guys, if you want to stay up to date with all of my latest stock and crypto picks, or if you just want some help with AMC and GameStop, be sure to check out the Patreon and the private Discord, linked in the description below, and become part of the team. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.